With the current value of the crypto market consistently falling week by week, it's easy to ask yourself, are we in a bear market? Throughout this video, I'll be answering this question, showing you how to identify a bear market, what a bear market actually is, and the safest and most secure place to put your money in these uncertain times. So what actually is a bear market? Essentially, a bear market has continually lower lows and a long-term downtrend for the overall crypto market. In contrast, a bull market has continually higher highs and the overall price of all types of cryptocurrencies will continually increase. With Bitcoin consistently falling in value over the past 7 weeks, so given the current trend of Bitcoin and the overall crypto market, I would say that we are in a bear market. But does that mean it's something to be concerned about, and should you sell off all of your investments? These ups and downs are a completely normal part of the market cycle. A lot of it is driven by human emotion and psychology in the short term, but in the long term there's other factors that play a role as well. Even stable investments like the United States dollar have ebbs and flows in terms of the price movements, but we just deem it to be a more consistent and safe investment and don't really factor in the volatility that it can have as well. Part of the reason why cryptocurrency is so volatile is because it's hard to accurately value how much it's worth. Taking a look at something like Bitcoin, which allows you to transfer funds in a decentralized way with no input from a third party and is deemed to be a legitimate threat to the current financial system, and it's even adopted as a national currency by countries like El Salvador. With decentralized lending platforms like Aave, you can even take out flash loans worth up to millions of dollars with no collateral needed, and you just have to pay the price of the gas fees needed to fund the transaction. With all of the different features that crypto provides, it's hard to actually determine what it's really worth, and other people are at the other end of the spectrum and think that crypto is just a Ponzi scheme and it's purely fueled by hype and speculation from investors trying to make a quick buck in the market. Taking a look at the factors that drive the ups and downs of these different market conditions, with a bull market there's more spending, people are taking out loans, and institutions have more money to use to generate different types of services and products. In comparison to a bear market where there's more debt and people have to pay back the loans that they've taken out, they're holding on to more of their money, and institutions have less capital available in order to grow their businesses and companies. The ebbs and flows of market conditions can be reflected by looking at the major stock market index, the S&P 500. You can see the consistent ups and downs that this index undergoes, but in the long run there's a consistent uptrend, while at times it can move sideways or go down for several years at a time. If you're looking at it over 50 to 100 year period, there's always a consistent increase in price, and it's easy to forget about the common nature of a bull and a bear market and just take it as something that needs to alarm an investor and think that they have to take their money out when there's a bear market or only invest when there's a bull run happening. With there being more and more institutional interest in cryptocurrency, the similarity between these two markets and their price movements has been increasing year by year. With Bitcoin, the amount that is available is cut in half every 4 years. Along with this reducing supply and increasing demand and interest, the price inevitably goes up. Since the price of altcoins, which are just any cryptocurrency that isn't Bitcoin, is heavily correlated to the price movements of BTC, then if BTC is going up in value or dropping in value, then altcoins will follow. And in terms of when a bear market happens, it's typically at the peak of a bull run and then is a successive reduction in value over a 1 to 2 year period for the whole market itself. Now that you know what a bear market is and how to identify one, what's going to be the best investing strategy for this kind of market condition? I would say dollar cost averaging is going to be the most consistent, reliable, and statistically effective way to make sure that you don't lose out in a bear market. Essentially, dollar cost averaging is when you put a consistent amount of money into the market, for better or for worse. Every single week or month, you're contributing a routine amount of money no matter what the market is doing. You're not trying to perfectly time the market looking for the best buying and selling points. This allows you to capture all the ups and downs of the market itself and promotes a long-term holding strategy instead of just buying when there's a bull run and only selling when there's a bear run. Instead of stressing about the short-term price fluctuations, which as you saw earlier in the video are a completely normal part of any market. With this strategy, what criteria should you be keeping in mind when selecting your crypto investments? The first one would be looking at the market cap of the crypto. This is because the higher the market cap, the more money is needed to drive the price down. Naturally, investments like Bitcoin and Ethereum are deemed to be a lot safer and consistent because they have much more mass adoption, institutional interest, and and a higher market cap in comparison to lower capped cryptocurrencies like Arweave, which only have a value just over $700 million. Lower capped altcoins are more like a startup company that has a lot of price potential and can make you a lot of money in a short space of time, but can also fall just as quickly, and they're a lot more risky than something established like BTC or ETH. Altcoins follow BTC with a price multiple of 1.5 to 3x, meaning that if Bitcoin goes up by 10%, altcoins will go up by 15 to 30%. This can also happen in reverse, so in a bear market, altcoins drop their value far greater than Bitcoin does. Taking a look at the price movements from the past week, Bitcoin has only gone down 18% with a market cap just over $560 billion at the time of recording, in comparison to something like Solana, which is still the 9th coin in terms of market cap ranking and has a value of 17 billion, has gone down almost 40%. So you can see that even within the top 10 coins, there's a lot of variability in terms of the price movements that can happen. The use case of the investment is also very important. Layer 1 cryptos that are used to pay for the transaction fees on their native networks like Ethereum, BNB and Bitcoin are always in high demand. The safety and security is always important for institutional investors because it makes it a safer investment for them and allows for more financial products to be made like ETFs that will drive institutional money. A supportive and engaged community is also key for a crypto's longevity. Looking at websites like CoinGecko, you can see the number of people that have added a particular crypto to their watch list, and on CoinMarketCap you can see the number of views that a crypto has had. You can see how much support there is, and looking at the views on YouTube and other social media platforms is also a good indicator to see how much support a crypto has. So now the moment you're most interested in, which cryptos should you be buying in a bear market? Number one is definitely Bitcoin. This comes as no surprise. It has the largest market cap, a very supportive community, and a lot of institutional and retail investor adoption. There's lots of money going into Bitcoin, and it is essentially the anchor for the whole cryptocurrency market. Number two is Ethereum. It has the second largest market cap and allows people to create decentralized applications or dApps. It essentially has a deflationary supply due to the gas fees needed to run the network, and it's even been speculated that it could beat out Bitcoin in the years to come. There are no real competitors for Bitcoin in comparison to Ethereum, which does have some competitors like Solana and Cardano. If Ethereum is doing poorly and can't keep up with these other types of cryptocurrencies, the money may end up flowing from ETH over to these other types of investments. And the third and final are stable coins. These include investments like USDT and USDC. They are directly tied one-to-one to the US dollar and have far less violent market fluctuations than other types of cryptos. This can be a double-edged sword because in a bull market they don't have very much price movement at all, but in a bear market they have little to no negative effects. You can even see that USDC has gone up by just over 0.6% over the past week, while other cryptos have fallen between 18 and 100%. While they have quite minimal price movements, using decentralized lending platforms like Celsius can be a great way to make some extra money, as they offer up to 7% interest on these types of investments and even 9% if you happen to be a platinum member on the platform. This is a great way to cancel out the minimal price movements that they have but still gain a consistent amount of money from them as well. If you're interested in learning more about the Celsius platform and how to make money from it, including how to take out crypto loans, earn interest, and a complete step-by-step guide to setting up the platform, then check out this video on screen to get a complete guide on how to use Celsius.